All right, everyone, welcome back to the channel. Today, we are digging into one of the absolute hottest stocks on the planet, AMD. I mean, its run has been nothing short of breathtaking, and we're going to figure out if this is the real deal or maybe just an AI bubble about to pop. Okay, let's just jump right in. To give you some perspective, the stock has shot up over 230% in just the last year. It's gone completely vertical. A move like that, well, it gets everybody talking. So when you see a chart like that, you've got to ask the big question, right? Is this just hype? Is it pure speculation? Or is there something real, something fundamental happening under the hood that actually justifies this wild ride? Let's find out. To get that answer, we really need to break it down. It turns out there are three main pillars, three core reasons that are responsible for this unbelievable breakout. It's really like a perfect storm. First up, the whole story around AI has changed. For a while, it was all GPUs, GPUs, GPUs. But now, the market's waking up to the fact that these new agentic AI models need a ton of CPU power too. And that puts AMD's server chips right in the sweet spot. Second, the demand is just off the charts, which gives them incredible pricing power. They can jack up prices by 10, even 20%, and customers will pay it. And finally, you've got these huge partnerships with the titans of the industry. We're talking OpenAI and Meta. That's a massive vote of confidence. So we get why it's rising, but the billion-dollar question is the price fair? To figure that out, let's pull out a classic framework from an investing legend, the one and only Peter Lynch, and see if this price actually makes any sense. You know, Lynch had different boxes for different types of stocks, and AMD, oh yeah, it fits perfectly into his fast grower category. We're talking earnings compounding way over 20% a year. And for these kinds of companies, he had a golden rule. Looking at the price to earnings ratio by itself is totally meaningless. You have to compare it to how fast the company is actually growing. So to do this, he came up with this really simple but brilliant tool called the PEG ratio. The math is super straightforward. You just take the company's forward PE ratio, that's what the market thinks future earnings are worth, and you divide it by its expected earnings growth rate. Simple as that. Okay, let's get our hands dirty and plug in the actual consensus numbers for AMD. Right now, Wall Street is looking at a forward PE for 2026 of about 41.5. Now, on its own, that looks pretty steep, right? But you have to pair it with this, an absolutely massive expected earnings growth rate of 40%. And boom, there's our answer. You divide that PE of 41.5 by the growth rate of 40, and what do you get? A PEG ratio of 1.03. Now, in Peter Lynch's world, a PEG of 1.0 is the magic number. It means a stock is pretty much perfectly, fairly valued. So this tells us that the market, believe it or not, is paying almost exactly what it should be for a company growing this fast. But hey, that's just one framework. It's always smart to get a second opinion, right? So let's see what a major research firm like Morningstar thinks. They tend to be a little more on the conservative side. And wow, check this out. They recently bumped up their fair value estimate all the way to $300 a share. So with the stock trading right around that level, even they're suggesting it's still slightly undervalued, even after this monster run-up. Now, what's really, really fascinating here is why they upgraded it. Morningstar spells it out that expanded partnership with Meta is so massive for future revenue that it basically wipes out any other concerns they might have had. That's a ridiculously powerful signal. Okay, this is where things get really fun. Let's put on our bull hats for a second and just play this out. What if AMD can actually keep this incredible 40% growth rate going for the next 3 years? What would that even look like? So let's run the numbers together. We start with the 2026 earnings per share estimate, which is about $7. Then we let that compound at 40% a year for 3 years, which gets us to an amazing $19.18 in earnings. Then, to keep it fairly valued like Peter Lynch would want, we apply a PE multiple of 40 to match that 40% growth rate. And that, my friends, is the insane power of compounding. When you do that math, it leads to a potential price target of over $767 by 2029. I mean, it just shows you how explosive this stock could be if everything goes perfectly. But, and you know there's always a but, right? Trees don't grow to the sky. 40% growth forever? Probably not going to happen. So let's flip this around and look at the bear case where this nasty thing called multiple compression rears its ugly head. Let's model a more realistic slowdown. Let's say growth goes from 40% down to 30 and then down to 20% in year 3. Now, earnings still grow to a very healthy $15 a share. But, and this is the killer part, the market is not going to pay a 40x multiple for a company growing at just 20%. No way. That PE multiple has to compress. It has to come crashing down to 20 to stay fairly valued. And the result of that compression, it's just brutal. You multiply those $15 plus earnings by the new lower 20x multiple, and you get a price target of just $305. So even though the company's earnings more than doubled, the stock price basically goes nowhere from today. It's a trap. And this right here, this slide is everything. When you see these two potential paths side by side, it tells the entire story. In the bull case, that high PE multiple acts like a turbocharger. But in the bear case, that same multiple gets chopped in half, and it completely wipes out all the company's hard-earned growth. The biggest risk here isn't just about earnings, it's about the multiple the market is willing to pay. So I guess I'll just leave you with this question to chew on. What's the real risk for AMD investors? Is it that the company itself will mess up and fail to execute, or is it that the market's expectations are just too high, and that Wall Street will simply stop believing the hype? Thanks so much for sticking with us for this breakdown of AMD. If you found this valuable, do us a huge favor and hit that like button and subscribe for more deep dives into the market's biggest movers. We'll see you in the next one.